$17 billion overnight. That's how much cash the system just grabbed from the Fed's window. And if you think this is normal, you have not been watching the pipes under the floor. Because while everyone was staring at the silver chart like it's a scoreboard, banks were sprinting backstage like the building's on fire. Not a press conference, not a headline parade. Just a quiet, urgent question being asked in the dark. Who has cash right now? And when the answer wasn't good enough, they went to the one place that always answers. Let me say this clean. I'm not here to scare you. I'm not here to sell you fan fiction. And I'm not going to drown you in math. This video is about mechanics, the simple human kind. What happens when silver moves so fast that the people who promised we can handle it suddenly need cash today, not next week? Because this is what a squeeze looks like in real life. Not just price going up. It's cash disappearing. It's credit lines tightening. It's risk teams saying, raise margin. It's traders saying, we need collateral. It's banks saying, we need funding. And then the Fed window lights up. Picture the room, not the fancy boardroom, the other room, the one with the tired faces, half-drunk coffee, and a screen that never stops blinking. A risk manager leans forward and says, silver is moving again. Another person says, okay, but we're hedged. Then a third person quietly replies, doesn't matter, the margin call still hits. Because hedged or not, when the price jumps, the system asks for cash. Not later, not politely, now. And when enough desks get that same message at the same time, the market turns into a hallway, and everybody tries to run through the same door. Here's the easiest way to understand it. Banks don't like borrowing from the Fed window in public, even when it's allowed, even when it's smart, because it looks like you needed help. So when you see big usage, whether it's $17B or $20B or more, it tells you something simple. Private funding was not smooth enough. And we've already seen just how big this can get. Reuters reported that banks tapped the Fed's repo backstop for a record $50, 35B, on the 31st of October 2025, a spike tied to month-end pressure and tight short-term funding conditions. So why is silver anywhere near this story? Because silver is one of those markets that can go from boring to violent fast. And when it does, it hits three groups at once. Short sellers who get trapped, brokers and dealers who have to manage collateral, banks who fund the whole machine overnight. Silver squeezes are not just price events. They're cash events. They're pay-me-right-now events. A squeeze is not magic. It's a human stampede. You have a group that sold something they don't want to deliver at these prices. They thought they'd have time. They thought the market would cool. Then price moves against them. And the market doesn't say, sorry. The market says, post more cash. And here's the part people miss. Even if you're not the one short, you can still get hit. Because if you're the broker, the dealer, the clearing chain, you're the one that has to ensure the money is there. When silver moves hard, the margin system starts squeezing everyone. A big client is short. Silver jumps. The broker calls them, hey, we need more margin. The client says, give me an hour. The broker says, no, we need it now. So the broker has to protect itself, which means the broker needs cash on hand to meet its own obligations. Now, multiply that by multiple clients, multiple desks, multiple banks, one thin window of time. This is how a metal move turns into a funding rush. The Fed's repo window is basically this. You hand over very safe bonds, and you receive cash overnight. It's like a pawn shop, but for top-level collateral. It exists so short-term rates don't explode, and so the system doesn't choke on a temporary cash shortage. And Reuters has been documenting this theme all through late 2025. Repo rates staying high, liquidity tightening into year-end, and the Fed responding with measures designed to keep short-term funding orderly. So when you see a big number hit the Fed window, it's not just banks being dramatic. It's not phrases, thanks for watching. It's the system admitting the private market wasn't enough today. Real panic is not loud. Real panic is administrative. It looks like higher margins, tighter terms, more collateral calls, less appetite to lend, more usage of backstops. And the Financial Times reported a clear sign of strain recently. Banks borrowed over $15B across 2 days from the Fed's repo backstop during a burst of short-term funding pressure. That's not a conspiracy. That's plumbing. Because silver has two features that make it dangerous in a squeeze. It can move fast as really. Silver can jump in a way that forces people to react immediately. It sits inside leverage bill. A lot of silver exposure in the modern system is not somebody holding coins in a drawer. It's contracts. It's financing. It's margin. It's short-term funding. So when the price spikes, it doesn't just change a chart. It changes collateral demands. And collateral demands change cash demands. And cash demands change funding markets. And funding markets are where the Fed lives. Here's the chain reaction in plain words. Silver jumps. Margin requirements rise. Clients scramble for cash. Dealers scramble for funding. Banks hoard liquidity. Repo market tightens. Fed window usage spikes. And the key point is step 4, because that's where institutions start making ugly decisions. Do we fund this position? Do we cut them off? Do we demand more collateral? Do we unwind? That's where squeezes turn into liquidations. This is where the internet gets confused. There are two worlds. World A, screen world. People watch price. They argue candles. They argue charts. World B, funding world. People watch overnight rates, margin terms, collateral demand, and cash flow timing. You can have a day where price looks fine, and funding is stressed. And you can have a day where price looks crazy, and funding is the real story. The Fed window doesn't spike because someone feels emotional. It spikes because someone needs cash to meet obligations. Let me tell you the moment this becomes real. It's a phone call that goes like this. Hey, we need additional margin. The client laughs. Come on, it's silver. And the broker replies, calm as a knife. It's not optional, because at that moment, it doesn't matter what you believe. The system doesn't price belief. It prices settlement, and settlement is cash. Some people will say, 17 billion isn't huge. Wrong frame. The point is not whether it's smaller than some crisis-era peak. The point is, why did it need to happen at all? Because in a smooth market, banks don't need to rush the window. In a smooth market, cash is cheap enough, everywhere enough, calm enough. When you see a rush, it signals friction. And friction is how small moves become big. No fantasy, no crystal ball, just clean possibilities. Scenario 1. Pressure fades. Silver cools, funding calms, window usage drops back down. That's the system exhaling. Scenario 2. Whipsaw, then higher. Silver stays volatile, funding stays tense. You get spikes around key dates, key settlements, key closes. That's the system coping, but not healed. Scenario 3. Chain reaction. This is the one nobody likes. A few desks can't meet margin fast enough. Positions get cut. Selling hits other assets to raise cash. Funding tightens again. Window usage climbs. That's how a metal story becomes a market story. If you want the clean signals, watch this list. Does the Fed window usage keep popping up? One spike can be a calendar event. Repeated spikes are a pattern. Do overnight funding rates stay stubborn? When funding stays tight, you'll see it in how hard it is to borrow cash against safe collateral. Reuters has highlighted elevated repo conditions into late 2025, even after rate cuts. Do we hear more official encouragement to use backstops? When Fed officials nudge banks to use facilities freely, that's usually because they want the market to stop treating it like shame. Let me slow this down. A lot of people get wrecked here because they do one of two things. They see Fed cash rush and scream collapse. They see silver squeeze and scream moon. Both are emotional. You don't want emotional, you want structural. Ask better questions. Is this a one-day funding issue or a recurring problem? Is the market functioning, or is it forcing the Fed to carry it? Are moves in silver causing broader cash stress? If you're not in silver, don't chase the candle. If price is ripping, let it breathe. Squeezes punish late entries because they swing hard. If you AR in silver, your job is to separate noise from signal. Noise, wild intraday moves. Signal, persistent funding strain plus repeated backstop usage. If you trade anything with leverage, respect cash days. When margin pressure rises, markets don't move like textbooks. They jump. If you care about physical, don't let the screen bully you. The paper layer can be loud. The availability layer is quieter but more honest. Why the Fed is acting like this, the control problem. Here's the real reason the Fed cares. They don't just set rates. They try to keep short-term funding stable enough that rates behave. And Reuters has reported the Fed is using Treasury bill purchases to manage cash and keep control of overnight rates around year-end turns. That tells you what the priority is. Keep the pipes from spiking, because if short-term rates spike, it breaks things fast. Even if stocks look fine, even if headlines look calm, funding breaks first. Cash stress travels faster than fear. Fear takes time to spread. Cash problems spread instantly, because cash is a rule. And rules don't wait for your feelings. When the system calls for margin, it calls today. When settlement is due, it's due today. So when silver triggers a chain of calls, you can get a Fed cash rush, even while the average person thinks everything is normal. That's the whole story. This can end in two ways. A calm ending. Silver cools, funding stabilizes, window usage fades. A loud ending. Silver stays tight, funding stays tight, and every spike forces another scramble. In both endings, the lesson is the same. Watch what institutions do, not what they say. The Fed window is not a rumor. It's behavior, and behavior is the truth. So if you take one thing from this, don't treat $17B from the Fed like a meme. Treat it like a sensor. A sensor that says, the system needed cash badly enough to go straight to the source. And when that happens during a silver squeeze, it means the move is no longer just about price. It's about stress. If you want the next update as this develops, subscribe, because the next signal won't be a headline. It'll be another quiet number hitting a back door at the exact moment the crowd thinks everything is fine.